Okay, so chapter 18, this is called incomplete records, right? It's very easy to understand chapter. It has very little things. There is like close to nothing that we have to understand. It's all, concepts. If you have understood the basic double entry, all of that, it will be very beneficial in this chapter, right? Now, let me give you a little background about this. So, incomplete records basically means that when there are some kind of people, many kind of people in the world who do not know about accounting, right? They don't know what is financial accounting. They don't know what is management accounting. Only the accountants know about this, and the people who are related to the finance, right? So there are some sole traders, especially in some countries, who are just operating their shops and businesses just for making profit, just for running the daily lives, right? Just for earning. They don't actually have much information regarding the accounting world. So it's the accountant's job to help them, right? And to provide them a service from which, from even a minor, from just minimal information, from just minimal effort, they can bring out a much more higher figures. Like, let's say, uh, just by using a specific type of T account, we can, let's say, by using a capital T account, we can find profit or loss, which is very difficult to understand, which is very difficult to think. But in actually, when we apply that, it's very simple, right? So incomplete records is basically, it's basically helping to assist those sole traders who don't keep proper records of their accounts, right? They just have like one or two or three figures from which we have to prepare their whole accounts, right? So this is the background of incomplete records. The same thing is explained over here in this paragraph, right? Now there are basically four methods for this incomplete records. You can see in this diagram as well over here that first of all, we can use the accounting equation to find out the missing figures. Now this first one and this fourth one, this first and the last one, these are the most asked ones in the exam and the most important ones as well, right? The second and third one we are also going to do in this chapter, but you'll probably see that they are very, very similar to the things we have already studied before, like the simple T account, simple double entry, bank reconciliation, control account reconciliation, right? It's very similar to that, like the normal receivables account, payables account. So this 2 and 3 is very much related to common sense, right? And 1 and 4 actually has good and interesting things that we have to understand. Okay, right? So I'll first of all jump onto the first method, which is using the accounting equation, right? Now, this four topics, don't think these are very detailed. It's very simple. Again, it's a kind of a break from consolidation. Consolidation was a very, very detailed topic, very huge topic. This will be a very easy to understand one, right? Now, first of all, you know what is the accounting equation, right? It's written over here as well. So assets are equal to equity and the liabilities. Assets is equal to equity plus liabilities, right? This is the accounting equation, right? So if a business has recorded very little information of its transactions, it may only be possible to calculate net profit for the year. So using accounting equation, we can say that we can calculate either the profit or the loss for the year. I'll guide you how to calculate that. Basically, we use this figure, which is equity one, and we expand it and make a T account regarding this. Okay, now this is basically shown as expansion over here. I don't think this is very similar but very interesting, but let's see this as well. So it's basically expanded this whole accounting equation over here. It's written total assets is equal to, so total assets contain both things, right? Current as well and non-current as well. We've already looked at this. And equity, now it's breaking down equity, right? Now equity contains these three amounts mainly, right? Share capital, retained earnings, maybe share premium as well, but that's covered under other reserves, right? And plus other reserves. So this whole bracket is expanding the equity section, right? And liabilities is also total. It contains the non-current as well and the current as well. So this is kind of like an extraction for the accounting equation, just to understand it easily. Okay. Now the main thing over here is this formula. I'll explain it in just a while as well, right? And this is basically used for the calculation purpose, for calculating mainly the profit or loss figure, right? So we could expand this further to disclose each non-current and current asset and liability. However, that is not necessary, as this all represents is the captions on the financial position. Now over here, there is a formula written for retained earnings. RE is basically retained earnings. right? So closing retained earnings is equal to prior year's retained earning figure plus this year's profit or loss minus dividends. It's actually true as well. What happens is that I told you that everything in the statement of financial position goes as a closing balance. Nothing opening is written over there. Everything regarding the closing balances is written, right, in the financial position. Now, what happens is that it's very true that what's happening over here is that the prior year's retained earning figures means the opening balance. Because if you think from an open mind, the previous year's closing figure will be this year's opening figure, right? Right. So
Mm-hmm.
in opening balance, we add this year's profit or loss because I told you profits and losses which are retained within the business are also added in the retained earnings. It's also a reserve, a readily available cash for the business, and minus dividends because this we already discussed in the capital structure that dividends we pay from retained earnings. No other reserve, we just use retained earnings for paying dividends, right? Now I am going to expand it even more. It's actually not explained, it just goes on to the next approach over here, right? That's the drawback on this one, on the study text, and that's obviously why teachers are here for. So let me expand it more and give you the main message in this. Okay, now the main thing that we're discussing over here is the capital figure, because this accounting equation is what we use for calculating the profit or loss, right? Now if you look at the accounting equation, this is the accounting equation. Asset is equal to capital plus liabilities, right? This one. So for finding capital, what we do is we just rearrange the equation. So what we do is capital is equal to assets minus liability, right? I can rearrange it and write it like this as well. So we can say that capital is equal to assets minus the liabilities. Now there is one more word used which is not used over here in the study text. You might heard it in real life as well. It's basically called net assets. Okay. Now net assets is a very interesting word because it has the word net. Net basically means to minus something or to subtract something or to take out something from any figure, right? So the word net assets, always remember the formula of this is exactly as capital. So what we do is asset minus liability, right? So in other words, in easier words, I can call it that capital is equal. In other words, we can call it net assets as well, right? Because both formulas are same over here. You can see net assets is also asset minus liability. Capital is also assets minus liability, right? So in short words, I can call capital as net assets as well, right? So this is the thing that we need to understand over here. Now I am going to talk about capital a little more over here. This is the thing that is not discussed in the study text. Okay. Now, again, the statement of financial position also contains capital, right? But capital in that case is sometimes known as equity, right? Equity, capital, both mean the same thing, right? Now, again, it's the statement of financial position item. So it should be closing. This we know already, right? Everything goes as a closing balance, right? So here I'm writing a formula. This is for closing capital because this is the figure that will go in the financial position, right? So this is the formula that I'm writing. Closing capital is equal to opening capital, right? Plus additional capital, any capital that we invest further within the year, right? And then after that, we add the profit, and we have, if we have any kind of loss, we minus this from it, right? And the final thing that we do is we do minus the drawings over here, minus drawings. So this is basically the whole formula for closing capital, which is the figure used in the financial position, right? So opening capital plus additional capital plus any kind of profit. If there is a loss, we minus it because it's kind of like an expense for the company, right? So loss is minus from the capital, and drawings are also minus because drawings are something which we take out for personal expenses, take out from the business, right? So this is the formula for closing capital. Now I'll write the same thing, exactly the same thing, in a form of T account as well, right over here. Let's write it above this because there is not much space. Let's write it over here. So I'm creating a capital T account, as you can see over here. This is capital. I'm going to write each and everything. If you want to understand from this equation, you can, more than welcome. If you want to understand from this T account, exactly the same thing, right? It all depends that what person learns from which technique. Okay. Now capital is a group 2 item. You remember this very well. We studied at day 1 as well. Group 2 items
Yeah.
included capital, liability, income, sales, all these things, right? So all the group 2 items have opening balance on the credit side, right? So opening capital will come here, and closing capital, which we probably will have to find, or in many cases there will be given to you in the question, it's written on the debit side, right? Now let's write the other things. Any kind of additional capital, because we are introducing the capital, right? It will be written on credit,
Yes.
because credit side is increase over here, debit side is decrease over here, right?
Yeah.
Now if we have any kind of profit, we write this on credit side as well, because profit increases the capital, right?
Yeah.
And if we have any kind of loss, we write on this side. And in actual terms, these are basically the balancing figures. This is in most cases what we'll have to find in the question. Okay. And the final thing over here is drawings. Drawings is the only things we is the only thing that we are minusing from capital right here. Okay. So this is basically the whole capital T account. And if we look at the perspective of accountants, it's exactly the same thing as this one. So this equation is fully equal to this T account. If you want to understand from this T account concept, that's also fine. If you want to understand from this equation as well, that's also completely fine.
It's the same thing then.
Exactly, it's the same thing, right? But there are two
Okay.
different methods of writing it. I would suggest if you understand both of the concepts, that would help you in the exam as well in doing some of the additional questions. Okay,
Okay.
right? So in most questions, what happens is that mostly, let's say you'll be given with opening balance, closing balance, additional capital, drawings. You will have to find either the profit or the loss, right?
Notes.
So
Okay.
till now we did not know this, that using the capital account we can even find profit or loss figures, because for profit or loss you only thought like this, like we have to make a whole financial statement, right? That is known as profit or loss. First we write revenue, we net sales, all kind of expenses, opening inventory, closing inventory, cost of sales, right? So there is nothing like this. We can use capital account just to generate profit or loss as well, right?
Yeah.
So this is the implication of the incomplete records. This is the
Mm-hmm.
importance of this. We can call this is like a magic of capital. Capital can easily calculate the profit as well and the loss as well. Okay, so this was in summary, this was the whole concept. These things which I have written over here in the note, I will be sending you, and these things actually are not written anywhere in the study text, because you can see this approach just ends over here, right? And the next one starts.
So sorry, the capital
Yeah.
that you have showed to me is the
Mhm.
same here closing if you go on the book.
Yeah,
The,
one second.
that formula closing is
Yeah,
the
so
same.
basically this is the closing retained earnings, right? This is not
Okay.
the capital. Retained earnings is
Okay.
basically a separate figure, right? So I would not
Mhm.
say this is much important over here. The more important things are right here, which I've summarized it over here, right? Like capital is net assets is asset minus liability. If we expand this, this becomes into this equation. If we write this equation into T account, it becomes like this, right? But if you want to learn this retained earnings equation, let's say for like general knowledge, it's very good to know, right? Because retained earnings, we know one or two things, that profit goes into retained earnings as well, and dividends are paid out from that as well, and opening balance we adjust according to all the things.
Okay, that's fine.
Okay, right? So when we'll go on to the questions, hopefully today you'll be understanding even more of this first approach. Okay, so this was the first one, which was using the accounting equation to find out either the profit or the loss.
Okay.
Right now, this is the second approach over here. You can see this is called a ledger account balancing figure approach. Now, this was what I was talking about, the second and the third approach. This is the second one. This is exactly the same. We have looked at it very much times before, right? So you can see, first of all, there is a T account of cash in bank. Then we have a T account of cash in hand, right? So it's exactly the same thing, like the cash book and the bank statement, the summaries, all the things that we've studied. It's exactly the same thing. There is no difference. You can see cash at bank is also an asset, right? Cash in hand is also an asset. There is no difference in between them, right? Now, if we look at this T account, cash received from customers. So obviously we have received them, right? So think about the double entry. It will be like debit cash, credit receivable, right? So cash is being increased, right? Again, banking from cash in hand. Banking means that we are investing in the bank. We are taking out from our personal pocket and putting it in the bank. So again, bank is being increased over here, right? Any kind of more incomes are also increased. So you just need to know that the addition side is here, the deletion side is here. Any payments are made
Right, banking from cash is like we're receiving cash then.
the banking one, right? You see this
Yeah.
this account is cash at bank, right? In short, we can call it bank. Let's say I have like $1,000 in my pocket. I want to pay them in the bank because I think it's not safe to keep in my pocket. It's a huge amount, right? So I go to the bank and I deposit it in my bank, right? So in actual, what is happening? The bank is being increased, right? So this is originally all the things that we have studied. You can see some more ledger accounts being listed over here as well. Cash at bank, cash in hand. We have looked at this. Receivable and payable. It's exactly the same one that we've already discussed in the control accounts. Okay, because this is the missing figure is basically telling you that it may ask you to find credit sales, credit purchases, money received. So these two things we've already looked at in that chapter in very much detail as well, right? Remember? And from this cash account, it's very simple to calculate the receipts and payments because the debit side is plus, credit side is minus. Same goes here with the cash in hand as well. Okay, right? So these are very simple. After that, it's that one receivables, remember, right? So receivable and payable is exactly the same. Only you have to remember that receivable is an asset and payable is a liability. Its opening balance comes on credit, whereas receivables opening balance is coming on debit side. Okay, right? Let's do as a test, let's do this question just to prove that we've already done this before as well. Now, what are the total sales for the year? Right now, please note it's saying total sales. Total sales means it may include cash as well and the credit ones as well, right? Now, receivables at the start of the accounting period for B Rebels business were 30,000. That means this is the opening balance. 30,000 is the opening balance of receivables account, right? There were total receipt from customer of 55,000, right? Of which 15,000 relates to cash sales and 40 relates to receipts from receivables. So now we know that receivable account only relates to credit, the credit ones, right? But we will only include the credit cash received over here only, right? Because you can see the cash sales are 15,000 and the credit receipt, the receivables receipt is 40,000. So we'll include this 40,000, not this 15,000. I'll tell you what we'll do with this 15,000 because this receivable only relates to the credit sales, right? Now, contra is also written over here, 3,000, and closing receivable balance is 37,000. Let's start doing this question. It's very simple. This is a receivables account, right? So the opening balance on debit is 30,000. It's already given. Closing balance is over here, 37,000, right? Now, total receipts we write on this side, cash received, and this is 50. Now, this from this we just have to write 40,000 because remember in receivable we just write the credit cash received only from credit customers, right? And contra is 3,000, right? This is the contra, which is 3,000 we write on here, right? Now this account is complete. We basically have to find the sales, right? This is the balancing figure.
Yeah.
Now let's balance this account. So the heavier side would be this one. So 37 plus 3 plus 40. This is 80,000, right? 80,000 over here and 80,000 over here. Now simply we minus 80 from 30, which is 50,000, right? So that means the sales are 50,000. The credit sales is 50,000. We needed to find the total sales, right? So total sales includes the credit sales as well and the cash sales as well, right? Now cash sales, you can see this 15,000, it's already given in the question. So we don't need to calculate it. So 15K is the cash sales and the credit sales are 50,000, right? So 50K we calculated using this receivables account because this only relates to the credit sales, not the cash ones. So 50 plus
Okay.
15, this will give us a total answer of 65,000. These are the total sales. So you can see there is nothing different. We are just applying the same control account reconciliation formats over here. There is nothing different over here. Okay.
Okay.
The only difference is in the method 1 and the method 4 that we're just going to see. Okay. Same accounts over here as well. Oh, sorry. 1 second. Okay. Same things are over here as well, right?
Yeah.
Now, these are again some same kind of questions. Now, this is the third method, which is using cash or bank summaries. So you can see that over here it's written use of bank summaries is similar to the ledger account approach. This method assumes that whilst data may be missing from the ledger accounts, a company can always reconstruct their cash inflows. So it's exactly the same thing that we just studied in method number 2, which was just to make, the cash accounts, the bank accounts. And it's actually very similar to the to the bank account reconciliation as well. Okay. Now this is a big problem over here, a big solution. I don't think we need to do this, right? It's exactly, you can just consider it as exactly same as the method number 2. But once we do the questions, you'll understand it even more. You can see the control accounts are being made, bank statement and cash book, all of these things, right? So when we'll do the questions, right now you can just understand it as just same as method number 2. Now we're moving to the last one, which is this one, markup and margin. This is, I would say, the most asked one and the most important one, right? Because mostly in the exam, this method is asked.